Good day, you're watching Businessworld Live. I'm Jes Delos Santos and here are today's top stories. Inflation likely quickened last month on the back of rising food and transport costs. Rosy economic outlook, Bangko Sentral Governor Felipe Medalla forecasts second quarter GDP to have grown by up to 9%. Heads up, motorists expect mixed adjustments in oil prices this week, with diesel products set for a decrease while gasoline prices are likely to increase. And tributes continue to pour in for former President Fidel V Ramos, who passed away at the age of 94. We begin our broadcast with inflation expected to have accelerated in July. A Businessworld poll of 14 analysts yielded a median estimate of 6.2% for last month's CPI, faster than the 6.1% print seen in June. If realized, the July inflation reading would exceed the Bangko Sentral's 2 to 4% target band for the fourth straight month. BSP Governor Felipe Medalla expects inflation to fall back within this target range next year. The central bank says inflation for July was driven by the continued increase in food prices, further transport fare hikes, as well as the weakening of the peso. But the BSP says lower oil prices and a cut in electricity rates are likely to temper price pressures. The PSA will release the July inflation print on Friday, that's August 5th. Now, another one from the Bangko Sentral, Governor Felipe Medalla forecasts the economy to have expanded by as much as 9% in the second quarter. Medalla believes the country's GDP may have grown by around 8 to 9% in the April to June period as economic activity picked up under the more lenient alert level. For the entire year, Medalla said his personal GDP growth projection is at 7%, the midpoint of the government's 6.5 to 7.5% target. All right, on the back of that optimism that economic growth was sustained in the second quarter, can the property sector say the same, especially amid high interest rate and inflationary environment? To discuss that, we have on the show Joey Bondoc, Associate Director for Research at Colliers Philippines. Good morning, Joey. Thank you for joining us.
Hi, Jess. Good morning.
All right, now you have the central bank already on tightening mode here. They, in fact, might raise rates by another 50 basis points in a few weeks' time. How might that affect the property market, and how soon might we see its impact on your numbers?
Definitely, it will have a significant impact on the property market, especially if you talk about condominium demand, residential take-up across the country, because this will definitely result in more expensive financing of your housing loans. But not just for the residential market, especially when you talk about interest rates, it affects a lot of businesses across the spectrum. So even if you talk about the BPOs, manufacturing companies, this rising interest rates might clip their plans to expand. And of course, when you talk about the traditional companies, that will have an adverse impact on their expansion plans. So they will likely take up smaller office space or perhaps hold off expansion. Even for manufacturing companies, rising interest rates will have an impact on their operations. So that might also curtail them from expanding operations. So that will also have an impact on industrial space absorption, especially in the key industrial zones across the country.
Okay, historically though, I mean, this is not the first time that the BSP has been on a hike mode here. It has been done, at least if I'm not mistaken, back in 2018. Can you give us an idea here in terms of numbers? How might that impact your outlook here for the property space, especially for the residential sector?
It's good that you highlighted that, Jess, because in 2018, even if the central bank raised interest rates, we have to note that 2018 was a very good year for the pre-selling condominium market in Metro Manila. Why? Because at that time, we have a Pogo demand. So Pogos played a significant role in raising the demand for condominium units, for pre-selling condominiums across Metro Manila. In fact, that was a record high, 57,000 units sold in the pre-selling market. And that was mainly driven by this Pogo demand, and that has resulted in aggressive development of condominiums, especially in the Bay Area. And even for the office market, that was a very good year, again, because because of the demand from Pogos. 2017 up to 2019, this is a period when we would see 1 million, almost 1 million square meters of office space being taken up in the market. And then in the pre-selling condominium, an average of 50,000 condo units sold in the pre-selling market. So even if you saw interest rates rising during that year, that was a pretty good period for the property market overall.
And that, I guess, also marks the difference between then and now. I mean, are Pogo numbers even back for us to be confident for them to actually somehow bump up growth for the property sector? It's very interesting as well in your report that you're seeing an emergence of non-Chinese Pogos. Can you nuance that more for us?
That's correct, Jes. But looking at our second quarter report, we're only recording deals from Pogos ranging from 11,000, 14,000 square meters per transaction. These are deals in the Bay Area as well as Circuit area here in Makati, French. We're no longer seeing a single transaction from the Chinese Pogo companies wherein they would occupy 30,000, 40,000 square meters of office space in a single transaction. And these are mainly Southeast Asian Pogos, meaning they cater to the Southeast Asian market. You have the likes of Vietnamese, Indonesian Pogos. Of course, in China, it's still a no COVID, zero COVID policy, still a tight lockdown, so we're still not seeing Chinese tourists or Chinese employees trickling into the Philippines. So it might take time for these deals to materialize, although they've been sounding off some queries, not just for office, but even for condominium, multiple condominium units.
Okay, now outside of Pogos, your report at least is quite bullish or hinging or really dependent on a return to office trend that we're seeing at the moment. But also, that's happening on the back of high inflationary environment. How might that affect residential leasing?
Well, for the residential leasing, Jess, what we have been seeing overall in the market is because of this return to mandate office of some companies, employees are now looking for condominium units to lease out. So these are the major business districts in Metro Manila, Makati CBD, Ortigas Center, Bay Area, Fort Bonifacio that are primarily benefiting from these stronger take-up of condominium units for rent. However, there still are substantial number of condominium units for lease in the market, and that's one of the reasons why we're still looking at vacancies ranging from 17 to 18%. There will be a slow recovery, almost 2% increase in rents, but it will be a slow, gradual recovery. And then because of a lot of units in the market that are vacant and are for rent, yields are also starting to compress. We saw yields peaking at about 7.1%, previously 8%, and now they're down to a little over 4%. And that has been resulting in, slower launches in the market. Developers somehow holding off new launches, and let's see moving forward if how developers respond to this rising interest rates.
Okay, slow take up there in the residential space. Entirely different picture for the office market here. You're seeing robust demand here for the office space, but that also happens at the time wherein there's a looming recession, especially in the West. How well positioned is the country to actually take advantage of this recession?
Well, we would like to believe that the Philippines will benefit somehow from a global recession. We saw this 2007, 2008, 2009. Some companies in the United States ramped up outsourcing activities from the Philippines, outsourcing some of their services here because they had to save on costs. So that has resulted also in greater office take-up, especially after the global financial crisis 2009, 2010. In fact, some reports say that the U.S. economy could have grown at a much faster pace if a lot of companies really outsourced their activities from key outsourcing destinations such as the Philippines. And also, I have to note that the peso is depreciating. So it is now much cheaper to outsource activities from the Philippines. $1 can now purchase 54 pesos, 55, 56 pesos worth of service. So that has that should have a positive impact on office space absorption moving forward. And again, we project the BPOs to dominate the office take-up across Metro Manila over the next 12 months.
All right, lots of factors playing out well for the office space market. Can you say the same for the retail space here? I mean, let's pick up a report from the Inquirer here saying that SM Prime will be charging mall tenants in full again. That's after giving them concessions over the course of the pandemic. Should other developers follow suit, do you see this affecting the rebound you're seeing for the retail sector?
I think so. I think it's about time also for some mall operators to follow suit. And in fact, we're glad with this news because back in fourth quarter of 2021, we in fact projected that rents will start to increase 2023. So somehow this calls to now charge full rents from retailers is aligned with our projection of an increase in mall lease rates starting 2023. But I think it's also justified because you now see consumer traffic footfall across malls in Metro Manila back to 60-70% of pre-pandemic level. And we see revenge shopping, revenge dining across Metro Manila. I went to a mall in Makati yesterday and it's back to the brim.
Yeah, that's definitely the case, especially during the weekends now. It seems as though we're really over the pandemic. But this time around, also based on your report, you're making a push for data centers. Why is that, and could interest to develop such facilities be held back by possible imposition of tax on digital services?
That's correct, Jess. But you have to note that the Philippines remains an ideal hub for data center development across the region. Note that back in 2020, 2021, Singapore imposed a moratorium on data center development. However, they lifted already this ban on data center construction. So somehow we saw the Philippines attractiveness or competitiveness at the data center hub improving, but now we see greater challenge from a Singapore data center market. But it's not just e-commerce that has been driving demand for a data center. You have the government's push to digitize, you have BPOs that will require data centers, even hospitals, as they need to digitize their records moving forward. So definitely this is one segment that we need to watch out for, especially for the industrial sector, and yields are very good at this point.
So maybe no better time than now to actually develop or cash in those data centers. Thank you very much for your time this morning. Joey Bondoc, Associate Director for Research over at Colliers Philippines. Let's pause for a quick break. Let's take a look back at the life and legacy of former President Fidel V Ramos, who passed away at the age of 94. More of that and other stories when Businessworld Live returns. Stay with us. You're still watching Businessworld Live here on One News. I'm Jes Delos Santos. Tributes and condolences continue to pour in for the family of former President Fidel V Ramos, who passed away July 31st at the age of 94. President Bongbong Marcos says he is mourning the death of not just a good leader, but also a member of their family. Recall that Ramos's mother is the first cousin of Mariano Marcos, the grandfather of President Marcos Jr. The chief executive says the FVR legacy will always be cherished by the country. Vice President Sara Duterte also paid tribute to the former president. She recalled Ramos's top accomplishments like signing a peace agreement with the MNLF, ending a 24-year Moro-armed revolution. Duterte also touted Ramos's efforts in, quote, championing Filipino competitiveness through his Philippines 2000 agenda. Foreign Affairs Secretary Enrique Manalo, meanwhile, highlighted Ramos's contributions to foreign policy, including overseeing the beginnings of ASEAN's expansion. And House Speaker and Lakas CMD President Martin Romualdez is also mourning the passing of the former chief executive who was the party's chairman emeritus. Romualdez praised Ramos's brand of leadership, which he described as tough when necessary, but with a caring heart for the common Filipino. As the nation mourns his death, let's take a look back at the life and legacy of the late former President Fidel V Ramos. Ramos, born in Lingayen, Pangasinan on March 18, 1928. Growing up, he attended the U.S. Military Academy and the University of Illinois. In 1972, late former President Ferdinand Marcos Sr. appointed Ramos as chief of the Philippine Constabulary after entering the Philippine Army. Almost a decade after, Ramos became the Deputy Chief of Staff of the Armed Forces after the presidential elections in 1986, in which Marcos claimed victory despite allegations of electoral fraud. Ramos switched sides and supported late former President Corazon Aquino. During Aquino's term, he served as Military Chief of Staff and Secretary of National Defense, and not long after, Ramos was elected as the new president of the country. As the head of state, he was known for his liberalization of economy, among others. His administration also succeeded in reaching peace agreements with two long-active guerrilla insurgencies, the New People's Army and Moro National Liberation Front. The government's gross borrowings declined by over 40% to 1 trillion pesos in the first half of 2022. This comes as the government tapped less debt amid the economic reopening. The Treasury reports that new domestic debt last month fell 28% year-on-year. However, external gross borrowing rose 55% in June due to new loan programs and project loans. The Bangko Sentral may still lower the bank's reserve requirement ratio before the end of the year. The BSP is yet to decide if the RRR will be cut right before or simultaneous to the expiration of the rule that allowed bank lending to MSMEs be considered as compliance to the requirement. Recall that the central bank made the rule as businesses struggled to stay afloat during the pandemic. The BSP earlier committed to bringing down the RRR of big banks to single digits by 2023. The RRR for big banks is currently at 12%, which is one of the highest in the region. Now, this from the Philippine Star. Bond listings on the Philippine Dealing and Exchange Corporation, or PDEX, are projected to set a new record high this year. This as more banks return to the domestic bond market for their fund needs. PDEX President and CEO Antonio Nakpil said that the bank issuer community has returned to the debt capital markets with, quote, fervor. Nakpil said this on the sidelines of the listing of the maiden bonds of the Bank of Commerce, which is the 7th bond listing made by a bank so far this year. With the bond listing of San Miguel's banking arm, Nakpil added that the amount raised through PDEX has reached over 350 billion pesos. Now, Uni Oil is forecasting mixed movements in fuel prices this week. In its weekly forecast, Uni Oil says that diesel prices could go down by 60 to 70 centavos per liter. Gasoline prices, however, are expected to increase by 60 to 80 centavos per liter. Now, more central banks are expected to hike rates this week to combat rising inflation. Let's hear more of what global economic developments we can expect on the week ahead, courtesy of Bloomberg.
Let's take a look at your week ahead. The RBA expected to raise rates by 50 basis points on Tuesday. On Thursday, the RBI and the Bank of England also set to hike their key rates. Economists are predicting a 50 basis point increase for the BOE and 25 bips for India. We'll also be getting US jobless claims a little bit later this week. Those numbers will likely show fewer job openings as optimism on the US economy deteriorates. All of this as the much anticipated OPEC Plus meeting gets underway as well. That's on Thursday. The Biden administration is hoping that Saudi Arabia can help ease oil price pressures by pumping more crude. Sherry.
Heidi, on the earnings front, we're expecting results from a raft of tech companies. PayPal, Uber, and Airbnb are set to report on Tuesday, with eBay, Robinhood, and Expedia set to reveal their earnings after that. Also in Asia, results from Alibaba and Toyota are due Thursday. Alibaba may give details on a planned move to seek a primary listing in Hong Kong. And that's your week ahead.
And those are the biggest stories on the economic and corporate front today. I'm Jes Delos Santos. We are One News, all sides, all the time. Don't go away. We'll give you the latest on the local bourse when Business World Live returns. Stay with us. All right, days ahead of the July inflation data to be released Friday. How should we expect shares to move this morning? Well, as you can see right here, you have the index starting the day in the red here. The benchmark here down by 0.5% to 6,282, reversing that gains we saw last week, wherein we did see the PSEI ending the week at the 6,300 level. Earlier, of course, we did report a number of analysts expecting still inflation to remain elevated for the month of July, but more than the inflation report, investors, of course, expected to take cues here from the earnings numbers for the second quarter. And we start the week with a big one here coming from the country's biggest lender here, BDO. As you can see right here, net income for the second quarter of 2022 is up 11% to 12.2 billion pesos. Net interest income also higher by 9.6%. to 35.54 billion pesos. That pushes first half net income to 23.9 billion pesos, higher by 12%. Customer loan portfolio likewise also growing 9%. Non-interest income also pushed by expansion in fees and insurance premium. Non-performing loan ratio also cooled to 2.39% from 2.72% quarter on quarter. However, despite that double-digit growth here for BDO, you can see the stock right now starting the day in the red, down by 1.4% at 117 pesos and 80 centavos a piece. Now let's try to check the financial space here as a whole. As you can see, let me just refresh this chart right here, because more, other than the report here of BDO and their earnings for the second quarter, we have to consider as well that loan growth accelerated for the month of June. That expanded 12%, its quickest pace yet in 2 years. That's amid the BSP already on a tightening mode to slow down inflation. Again, that loan amounted to 10.19 trillion pesos. You can see right here a number of our lenders starting the day in the red. BDO, of course, the biggest loser so far, down 3.25% here. That's 2.4%. Union Bank is a stock here that's down by 3.3%. BPI and Metro Bank also likewise starting the week in the red. And then lastly, let's have a quick check of our property developers here. Let me just refresh this one very quickly. Unlike the banks here, the property space starting the day in the green, up by 0.5%. That's amid, of course, the Inquirer reporting that SM Prime will be back to charging full mall rental fees rather, as they slowly let go of pandemic concessions. The report says SM Prime is confident enough to actually unwind concession for mall tenants. Inquirer reports that SM waived as much as 23.3 billion pesos in rental and other charges in 2020, resulting in a slowdown in mall revenues for 2020. Stephen Tan, president of SM Supermall, says that May and June, at least, majority of malls already exceeded their 2019 sales, and they are confident that business is already back again. A number of our property developers, small developers to be exact here, starting the day in the green, the likes of Ayala Land and Mega World, as well as Philinvest. However, on the flip side, Robinson's down 1.2%. And that's it for today, August 1st, 2022. Join us again tomorrow at exactly 9:30 a.m. You can also catch us on Signal Play. Register for a free account now at www.signalplay.com and stream One News Live anytime, anywhere. I'm Jes Delos Santos. Mask on, wash hands, and stay safe. Philippines, we are One News, all sides, all the time.